there's a few themes in terms of changes in global capital flows. So we're seeing a lot of expansion into Asia, which we saw last year. We expect a continuation of that this year. Americas looks pretty flat year on year in terms of volumes, but Europe is actually seeing a bit of a decline, probably about 10% down relative to last year. So there's not a big drop-off, but we're clearly seeing a cooling in the investment market into Europe. We're definitely end of cycle. We're also seeing maybe the occupier market move towards the end of its cycle, and we're also seeing the economy starting to cool off. And that's having an impact on what people are buying and what they could be buying in future and what investors could be coming in to tap into those opportunities. If we look at the capital coming into the market, there's definitely an increase in Asian capital. It's tripled in the last 3 years, so it's about 30% of cross-border capital now comes from Asia, and a lot of that historically has come from China. More recently has been coming from Korea. Increasingly we could see more coming in from Japan. The signs that the Australians are coming back in ever so marginally, but again, they could show an increase in their interest, whereas North Americans' market share of Europe is actually starting to diminish slightly. So not quite sure what that trend means or how it's going to evolve, but it's definitely changing. Then if we look at product, what's being bought, there's definitely a big shift or continued increase into resi. It's gone from 6% at the end of the last cycle to about 16% now. Offices and retail are slightly off, hotels about the same, industrial also up. So that's the real structural factors and structural change that we're seeing through demographics, e-retailing, e-commerce, driving investment into those sectors. For offices per se, markets themselves as office markets are actually in really good shape. So there's a dominance of landlord-friendly markets for investors across Europe. We've got very low vacancy rates in many cities, and on average, absorption relative to availability is about 25%, which means on average, there's only about 4 years' worth of availability left in the market at current rates of take-up. So that's actually a really healthy position, and that's going to support rents. It also should be supporting development, which we're not seeing enough of, quite frankly. It certainly appears we're not, and certainly maybe not the right type of development. The other thing that's impacting offices is obviously flex working, co-working. It's expanded hugely in London. I mean, the size of that market in London relative to other European cities is staggering. It's at a different phase of its evolution, with traditional landlords now tapping into that and the premiums that are available over traditional rents. Obviously there's a cost to that, but that flex co-working model is definitely expanding across lots of other European cities now, and that's going to be an interesting thing for investors to tap into or figure out how they tap into it. Industrial side, again, it's still growing, logistics is growing, but we're seeing a bit more parity now with how it's going to trade off relative to retail, and I think retail will start coming back. So it's an interesting market. There's lots of diversity. There's lots of diversity in residential. We don't seem to be buying that much student housing or senior housing despite the demographic support. You look at things like Airbnb, and they're expanding massively in terms of the demand for it. So there's a demand for a diversity of types of demand for resi, and I think that's going to make the market interesting in terms of what you buy into. So overall, I think it's positive. Things might be cooling off. We're going to have some challenges around talent, and it's how cities and super metros and regions compete, build that talent, drive urbanization, and drive the kind of future hubs where people are going to invest into.